All righty. Meantime, crude oil falling below $80, lowest close since July. But our next guest says a potential wave of M&A in the energy space could have the market falling in love with big oil all over again. Sankey Research President Paul Sankey joins us now on the Fast Line. Paul, what do you see in oil as it goes down to its lowest level since July?
Risk off, obviously. I mean, I think the backdrop here was that the original Hamas attacks on Israel came right after Saudi was talking about some sort of agreement with the Biden administration regarding more oil in exchange for diplomatic relations with Israel. So the fundamental backdrop was actually quite, a mitigation of Middle East risk, which may have triggered the Hamas attacks. And of course, the Hezbollah leader comments on Friday really confirmed that more or less this is a localized event, a major one, albeit, but localized. At the same time, Iran is selling almost all its oil to China. So we don't see an Iranian outage, which is the really big risk of all this. So risk off it is. And that leads us into, combined with very warm weather forecasts and some weak Chinese export data and high Russian exports, there's a lot of things negative. We're focusing on M&A, as you mentioned.
What's the trading range for the commodity over the next, say, 60 days?
Well, at the moment, as I said, the weather forecast is red hot for US, which is the first thing. And, we're concerned about going into winter at this time of year, and it's looking very warm for the next 6 to 10, 12 days. So that's a bit of a problem. We do have a floor somewhat on oil because of the SPR, the Strategic Petroleum Reserve rebuild that kicks in at $79 WTI. So that will now provide a little bit of support here. So we don't see oil going much below 70 before winter. But, the situation in the Middle East was a lot of heat that really didn't affect oil markets when it came down to it. We had a minor outage of Israeli gas that affects European markets, but European gas markets right now are very, very well supplied.
So we've already seen a couple of deals in oil in the past 3 or 4 weeks. Who will be the next buyers? Who will be the next sellers?
Well, our argument is that the medium-rank oil companies, really from Oxy and below, Occidental Petroleum and below, need to scale up to get bigger to improve their multiples. And that's really a reversal of what we were saying for the past 5 years, which is that the companies should shrink to grow, should cut their capex, should increase their returns, and therefore increase returns to shareholders. In the case now, as we see Exxon buying Pioneer that you're referencing, Chevron buying Hess, what we're seeing is finally the big oils are getting the highest multiples. And that's a new era for the space. So we think we'll see a lot more deals. People are talking Devon and Marathon Oil. People are talking the potential for ConocoPhillips to do more with a private equity player. There's a number of things out there in the middle ranks that would really transform companies. In the Bakken, we expect to see consolidation as well. So there's quite a long list.